Welcome to the video, guys. My name is Krystallis. I'm the founder of Exit Deals, and I just wanted to take this moment to basically introduce you to what this podcast session slash video is essentially about. So, in this session, we sat down with Denis Mezheritskiy of ROI Business Brokers, which is a business brokerage within the US, and we basically discussed a couple of the key points associated with selling your business in 2021. We covered questions related to the SBA program and how it can help buyers buy a business more easily. And then on the flip side, we also covered questions related to the difference of selling an online versus a physical business, for example. So a lot of different value points, and essentially, yeah. So the first question that I have essentially is, when would you say is the best time to sell your business? Because you have a lot of business owners that are selling in distress, and you have, I think it's like really a minimum, right? The amount of business owners that are selling when their business is at a peak, just from the research that I've done.
Yeah,
It's really
yeah.
not.
Well, the biggest problem with it is that 80% of businesses don't sell, and they don't sell because they don't plan to sell. Um, you know, not planning an exit brings an issue, right? So that's why are 80% of the companies don't sell. It's too small. It's a job. They were never able to exit out of their position. You need to create certain sectors within the company to make it sellable. So if you're not thinking about exit from day one, that it creates an awkward situation where you can't actually exit. So you get to the point where you don't have a plan, and then everybody exits, right? One or the other, you either exit or you don't exit. You still, at some point in time, we all exit out of this life.
Mhm.
So the business will transition, and just unfortunately, most of those companies will transition in the stress, and that's not where you want to be on that exit. Somebody who plans, who understands how to plan the contracts with the employees, how to plan all the contract with your clients, with the customers, with the vendors. How do you plan your real estate, and that ultimately creates an option for an exit. Exit meaning a substantial amount of funds that could be exchanged for the business that you're currently in. Most of the things that you see out there is a distress sale. Hey, I have a I have a health issue. I need to retire. I can't work. So unfortunately, that's why the statistics are out there. Think about it. Like 8 out of 10 don't just close down. That's just crazy. It's crazy numbers.
So you're saying 80% of businesses, number one, don't sell, and then what proportion of businesses that are like listed currently on sale would you say are distress sales, essentially?
Well, a lot of I don't know what the percentage are. I think in general, I think like biz buy sell. I think there was like an article, like 25-35% of businesses actually sell, the ones that are listed through biz buy sell. I don't know how accurate that statistic is. There's some business brokerage firms out there that in the business of listing businesses and have a good quantity of companies that they can actually represent. So they take as many listings as they can, and they try to sell some percentage of it. And then there's business brokerage that concentrate on businesses that they're good at, that they're strategically able to work with. No, there's a higher percentage. So in terms of businesses that are listed, you go through some of those listings, and they completely make sense. Why would you pay for a job? Why would you pay for a business that is not producing enough cash flow for you to return on an investment, right? There just doesn't make sense. There's so many different classes of valuations, right? And what does your business actually value that? A lot of the business owners have a tough time understanding what that number is. So I think that not properly being valuated a lot of the time is the issue.
Got you. Yeah, so the valuation problem is definitely something that I want to touch base on as well. Can you, so like from the research that I was doing as well, can you explain a little bit the SBA system and how this, if I'm not mistaken, how this can be used to potentially purchase a business?
Yeah, SBA is a phenomenal program for business to buy companies. What the simplest way of thinking about SBA is not some kind of a glorified system. Think of it as insurance. Think
Okay.
of it as pure, simple insurance policy. So the government gives out an insurance policy. SBA, with Small Business Administration, they're acting as an insurer for those banks So if I'm Bank of America and I'm giving out a loan to a risky business, I mean, buying a business is risky. There's a lot of risk. Some of the companies have no assets. Like you take a healthcare company, right? Like a home health company, they have no assets. They don't have trucks, equipment. They're just employees. They're just goodwill. So what happens in those risky businesses, in the business in general, SBA steps in and say, well, if you insure your loan, if the Bank of America insures the loan through SBA, then the SBA will pay in case the loan is not paid off. The SBA will fund the bank with 70% of that amount.
Okay.
So they taking that risk of the bank on lending that amount. So, and the way the SBA works is if you are buying a company through an SBA, there's a percentage of fees that goes to an SBA at closing, which will be amortized through the loan, but that fee will be charged to you at closing, and that's how SBA as an insurance. I mean, it's not insurance, but that's how I like to compare it, because that's exactly what it is. And a lot of people think you go into an SBA and they give you the money. That's not how it works. You go to a bank that is SBA approved, they give you the money, and SBA will underwrite it and insure it.
Are a lot of banks SBA approved?
Tons of banks are SBA approved, but there's different types of loan for SBA. You can have an SBA loan for the real estate. You can have an SBA loan for the business. And you really need to know which bank to go to. There's some banks that they might have. For example, there could be a bank that they've been doing way too many HVAC company acquisitions, right? At some point, so they're looking at their portfolio and they say, well, we have way too much risk in one sector, so we don't really like companies in that sector. And not to pick on HVAC companies, just in general. So you really need to understand which banks actually do the lending, but tons of banks are lending.
Right. Okay. That makes sense basically. So if they're like overcommitted into like one sector, then they'll want to like diversify their portfolio with something else, essentially.
Yeah. I mean, that's exactly right. And also it's not SBA rules as much as individual bank rules. They might, the SBA will allow you to buy a business with as low as 10% down, but there might be some banks, they want to go higher. They want you to put at least 20% down. So every bank has their own policies. It's not really go in a cookie cutter way, but I mean the process is the same. So there's banks that are pre-approved by the SBA, and then there's other banks that work directly with the SBA. That doesn't really matter. If you have a broker, if you have somebody you've done business with, you should always be getting opinions from at least 2-3 banks at any given time.
If you work with a broker throughout the sale process, for example, do you reckon that a broker would basically know which banks are buying which businesses, for example, or which banks are giving funding for which businesses?
Yeah, I mean, it's tough to say. A business broker, like, I know which banks will lend on this deal. So when I'm representing I'm mostly representing sellers. So when I'm representing a client who's selling the business, I take down all their financial information, and before I have it listed, I actually take it to a couple banks to make sure that that I can get this business pre-qualified with SBA. So, but to answer your question, a typical business broker should know which has those relationships with banks. An experienced business broker knows the banks that one should work with, and absolutely can be a tremendous resource. Even though that he or she might be representing the seller, a business broker is a tremendous resource because they know exactly what steps to take in order to get this deal done.
Understood. Makes perfect sense. Now, on the topic of valuations, and I mean it's like it seems like a very very like prevalent problem with regards to the majority of the listings out there. They're listing themselves incorrectly with regards to asking price, etc. Just as a baseline, let's say for viewers that are interested in pricing strategies, what's the best way to price? How do you get a valuation, etc.? Just the basics of it.
Well, I mean, it's a loaded question. There's so many different ways to value a business, right? There's the asset value of the company. There are some asset-heavy companies that the asset value of the company will outweigh the enterprise value of the company. For example, take a good-sized trucking company. the equipment value of those assets might outweigh the actual enterprise value of the business. Or take a jewelry store, for example, right? A jewelry store, their inventory, their assets of the company will outweigh the enterprise value of the business. And then, so that's one way, right? Look at your assets. What is the current market price of those assets? But the most valuation method that we use is called the direct to market approach, which what we do is we look at the cash flow that the company produces. So the bottom line discretionary income or EBITDA of the company that the company is able to produce on an annual basis, historically. So valuation is a historic, like we're not like forecasting the opportunity, like based on the historic assessment of the company, the value, the company is able to produce so much cash flow every year to their owners per year on average. So we take that cash flow amount and we compare that business, that cash flow and the business that it produces to the same similar businesses in the industry. So if you take, for instance, you take a home health company, we can go through the financials of the home health company. We can understand what is the cash flow each year this company produces, what's the EBITDA, and then we can go back to our comparable reports and we can see, well, companies in this sector have sold 2.5 to 3.5 times the cash flow that the company produces. Just
So is it an industry multiple?
yeah. So so the multiple that we look would be, the multiple is always a range, right? There's a low range and then there's a high range. There's companies that sold that could be 1.5 times the cash flow, EBITDA or discretionary earnings, and it could be up to 4 or 5 times the cash flow. So where does this company fits within this parameter? So we really have to break down the company and look at the risks that the company has for this particular buyer to really understand, where is it more on the lower side, on the higher side, where is that multiple? But we look at the big sample of data, like we look at 20 different transactions in that particular industry, 30 transactions in that particular industry, and how does this company compares to the transactions that happened in the past? And that's how we're able to give an assessment of that value. But that just gives you the financial value of the company. There's some businesses that we represent that we do what's called a controlled and informal auction, is where we are looking for companies that could be a phenomenal strategic fit. So we would be looking for a company for how can we cross-sell different product lines and manufacturing that can take advantage of the retail sector. We're looking for that strategic buyer, and those buyers could potentially pay a higher price. So I'll give you an example of, for example, a physical therapy practice. If you take an individual physical therapy practice, 20% of the expenses are administrative costs. And typically in any medical practice, dermatology practice, 20 to 25% is billing, is admin, is all the appointment setting. There's a lot of cost that is admitted. Now, if I have an existing physical therapy clinic and I'm able to buy other locations, now my cost I already have that cost in my existing ecosystem. So now if I'm buying a practice somewhere that spends 20% of their revenue on administrative cost, that's cash flow for me. I'm not going to be spending that much money on administrative costs for the company. So I'm able to pay much more money for that company just because I have so much more cash flows coming to me. Now, so that's like a little bit of a strategic approach when valuing the company. So that's why we do a control auction on companies that we feel could be a good potential fit for those acquisitions.
Understood. So in that case, basically, it's like inter-industry purchases, for example, primarily for like strategic over the long term.
Yeah. I mean, you take industries like service industries, like plumbing or HVAC or electrical. You can take a company that could be a good hub that has everything already established. It has all the invoicing, administrative. It could be a good, nice platform. And what happens that's the private equity model. They buy a platform company that has everything already figured out, and they go out and buy those service companies from the business owners who started those companies 30 years ago. They do a great job, but again, they're spending a lot of money at admin costs, and they don't have all the processes figured out as well as a good platform company would. So for them, it's much easier to add on, and then you can go cross industry, and like HVAC company, and they can buy a plumbing company, right? And now they're able to cross sell services. So revenue models, like now we're making more money from the same database of clients. We can cross sell our product lines. Now our company is so much more valuable because, well, per client base, we're making a killing now. Not really changing much of anything else. So that's the model that we look for when we're representing sellers who are on the long term, looking to get a higher multiple size on that valuation.
Got you. Another question that I also have is like, what are the main differences that you see yourself as a business brokerage with regards to the sale of online businesses versus physical ones?
Online there's so much different. But under online businesses, there's so much different industries, so many different industries, right? Like I don't specialize in online businesses that are pre-revenue, right? My whole concept of valuation is working with companies who are revenue, they're bringing cash flow. So the companies who are looking to raise money or looking to raise funds, that a business broker is not a right fit. I'm working with the companies who are prepared for the exit and are generating cash flow, so that investors or buyers in that company are looking for that cash flow. At the end of the day, business is business. There's a certain amount of business that produces the cash flow. Based on that cash flow, we can estimate the value. So, e-commerce is phenomenal. It's very scalable. There's so much opportunity. There's a lot of cross-selling going on. It all depends within the company. Does the company owns the actual database? What is the intellectual property that the company has? Like you really have to break it down on molecules and really understand exactly where the company fits in on valuation. But yeah, e-commerce are phenomenal to sell because you can go nationally with it, right? It's not really it's not location bound for most of it. So e-commerce is a great platform, and they're really great to cross-sell different product lines as well. So it's a great company to sell as long as they have some intellectual property and value in those products, in those services, in those customers that they've served.
E-commerce, by the way, the valuation method for e-commerce is SDI, they do it on a seller discretionary income basis.
Yeah, so it's SDE. It's called Seller's Discretionary Earnings. It's the same process that would happen with e-commerce. It's the same process that will happen with a service-based company. There's a certain amount of cash flow that the company produces. What are the opportunities for the company to expand? For e-commerce, it goes a little bit more deeper, as it's not a lot of asset-based. Typically, not a very heavy asset-based business. So what is the recurring revenue from those clients? Because sticky revenue, like those recurring revenues, is where the money is on a lot of businesses. That's where the valuations are increased. Is how much of that how many of those customers are constantly buying and reoccurring sales. So, and what is the model on the business? Like companies who are able to create a membership style reoccurring revenues are much more valuable than the companies who work on order per order basis. Yep. Even the HVAC business, right? There's companies in the HVAC world. There's some that do only installation, right? They work with general contractors, they work with commercial contractors, and all they want to do is the installation, for new construction. And then there's other companies, most of what they do is a service. It's a monthly revenue that they can continuously charge those clients, those credit cards that constantly bill. So if I'm a buyer coming in, I would rather buy a company that gives me a good security that those revenue is going to continue to come in. Then, what if something happens with the real estate market and the construction industry goes down? Then what am I going to do with this company afterwards?
Is this a promise that a HVAC or a plumbing business offers, for instance? The security of recurring revenue and like extended lifetime value of a client?
Yeah, I mean, some companies, the smart companies, they take advantage of it. The recurring revenue is where, if you're planning an exit, then go back to your first question. If you start thinking about your exit from the day you own your company, then of course you're going to start to position your company towards a recurring revenue model. If you're an HVAC owner, but what's happening now, it's so busy. You can make much more. Like you can make more money doing new installations right now than you would on a service recurring basis. But this exit wise, like over time, the exit will be so much more beneficial on a recurring model, on the service based.
Okay.
I'm working with a HVAC company right now, and so typically the HVAC company, when they do the new installations, they put the tags in, right? They put their company name and the phone number. If it breaks down, give me a call. This company been around for 25 years. They haven't put a single sticker on equipment. So I don't want them calling me, and I understand. I don't want them calling me either, but they missed out on a lot of that revenue. So now they work 6, 7, 8 different general contractors. There's a lot of risk for a buyer. Like what exactly am I buying now? Am I just buying your relationships here? What if they don't happen? Like what am I gonna do? For that reason, the valuation of the company would be much lower than if there was a component of service built into the business.
If they had the recurring revenues, then right, understood. How much would the valuation be higher? I mean, it depends on how many recurring customers they have.
Yeah, I mean, I'll give you an example. We sold a company that was doing installation. They were doing $12.5 to $14 million in revenue a year. Okay. We sold it for $2 million. And then we sold a company that was doing service work. They had hundreds of contracts on a maintenance service work. They did $4.8 million in revenue, and we sold it for the same amount of money.
Right. Okay.
So that kind of gives you an idea, right? So at what level of company, how big is your company needs to get in order for it to be successful? The other problem when you're constantly on a new installation model specifically with HVAC companies is that your revenues are always like this. You have big jobs, and some years are phenomenal, and then you go through a period of time when you're catching up, and that revenue slips down. So if I am a buyer coming in, I don't want to see this, right? Because I don't want to be buying here and going there. Yeah. I want like nice easy flow.
What did the also, because you mentioned a couple of times the aspect of planning for the exit, like because there's going to be an exit either way, regardless of whether you plan for it or not. But if a business owner does actually choose to plan for an exit, what are the quickest, let's say, tidbit tips, quote unquote, that you can give for a business owner from the start, like from the get-go with regards to planning for an exit? Would it be like things like frequent valuations, for example, like stuff like that?
I would say that you have to start planning, like really start planning and understanding the value 5 years before your exit date. First, you have to understand, I feel like you have to understand what is the point of exit. At what point can you actually exit? Mm-hmm. What are you here for 10 years, 20 years? What is your projection? Where do you want to be at that number? So you can at least start that process of planning. You have to dedicate yourself in your thought process, always thinking about somebody buying a business. So when you're looking at your financials, you need to understand it a certain way. When you're buying a piece of property that your business is going to be operating, you need to be thinking in a certain way. Every single step of the way, you need to be thinking about what is going to happen with this particular decision if I do end up exiting. Because every single thing you do will either hurt you or improve your valuation. Right. So, I don't think valuation is needed like every single year. I think once you get to understand what the value is, but if you're not paying attention to your financials, if you're not paying attention to your employees, not paying attention to your suppliers concentration, if you're not paying attention to the risks that you present to those prospective buyers, you are putting yourself in a risk category that you will lower your valuation down the road. certainly. So there's things like employees. Well, how do you create agreements with employees if you are going to be selling a company? Real estate. What should your real estate contract should look like? If you're leasing the space, if you're buying the space, how is this going to improve your purchase price or decrease your purchase price at the end? What is the situation with the customers, right? What is the percentage of your your top 3 customers? What does that percentage comes into? If 60% of your revenue comes from 3 different customers, you have a problem, right? So now you're thinking, well, I need to widen that net. If all of your product is coming from one vendor, now you have a problem, and that risk will translate into a lower valuation, or not even being able to sell the company for any given time. So
because like one of the other questions that I have, like, that I actually wanted to ask on the record is why should they go with a business broker, which of course is pretty apparent considering the depth of the conversation at the moment. But another question that I have is, would a business brokerage accept to work with a business from the start if a business wants to sell in 5 years time and they want those 5 years for preparation, like based on everything that you mentioned right now? Like if somebody calls you and they're like, Dennis, I want to sell in 5 years time, right? What do we do? Would you accept to work with them?
Yeah. That's a great question. I mean, in terms of business broker, I feel like business broker should not be an expense. Business broker is going to be the resource that's going to bring you more money for your business. The business broker's fee should well be accommodated by the return that business broker brings into the picture. In terms of the process of working with a business broker up until the sale, we have, there's not such a thing as every business broker does, but what we do, I'm working with the company right now, they're looking to sell in 2 years. What we were doing, we're starting with the plan. What is the valuation of the company? So we do an opinion of value to understand where are we at right now. And then we do a risk assessment. So we present them with a report based on our analysis of where are the shortfalls of the valuation. And then we give them an idea of what that amounts to. So what is that gap in the valuation that they're missing based on those risks? So now they have a good understanding of where they need to be concentrating on. And we really will outline it. This is where it is. So now they have some time to get to prepare to the point that they're actually, anybody that's looking to sell, they need to have at least 2 years of. So for instance, I'll give you an example. If there are issues with finances, right? Which is typical in small companies. QuickBooks, profit and loss statements, they're not reconciled. They're not in order. It's a problem. Business owner is not putting all the money in the business. That's a problem. The business needs a minimum of 2 years of financial history for the bank. Like the bank needs at least 2 years of debt coverage to underwrite the loan. So if a company, if a business owner said, well, I haven't been putting in the money, all of it, which is completely dumb, then well, you can't sell, because we need 2 years of those returns to state that how much money you actually be bringing in, which is just crazy dumb. So there has to be some time pass on to file those tax returns so that now we can present, because remember, the valuation is based on the historic performance of the company up to this point. All that opportunity, that's what sells the company, but what values the valuation company is all on the historic performance of the company up to this point, with the projection of what it's going to be looking forward to.